There's a fundamental rule in modern finance that we rarely stop to question. The price on the screen is the truth. We check our phones, we see a ticker move from green to red, and we accept that the collective intelligence of the global market has reached a verdict. We believe that the digits flashing in real time represent the absolute intersection of supply and demand. But what if the screen is lying? What if the most sophisticated, well-funded traders on the planet have spent the last 18 months proving that the digital price of the world's oldest currency is a carefully constructed illusion? To understand the scale of the anomaly currently unfolding in the silver market, you have to look past the charts and focus on the pavement, specifically the pavement outside the vaults of Manhattan. Since October 2025, a quiet exodus has been underway. This isn't a speculative flurry or a retail craze fueled by social media memes. This is a systematic institutional drain of the COMEX ecosystem, the world's primary clearinghouse for precious metals. In the world of commodities, there's a massive difference between trading and taking. Most participants in the futures market are simply betting on the direction of a price. They settle their contracts in cash and walk away with a profit or loss. But for 18 consecutive months, a ghost participant has been doing something different. They aren't rolling their contracts forward. They aren't settling for paper profits. They are standing for physical delivery in quantities that have never been seen in the history of the exchange. Since late 2025, total silver inventory at the COMEX has declined by a staggering 31%. This isn't just a statistical dip, it is a structural hollowing out. Billions of dollars worth of physical silver are being loaded into armored trucks and driven away, removed entirely from the system. And yet, if you look at the price on your screen, you see a market that appears disinterested, even bearish. It is the ultimate paradox. The product is vanishing, yet the price remains stagnant. This is the great disconnect, and it is the most important story in the silver market since the metal traded for $1 an ounce. To grasp the precariousness of this situation, we have to look at the registered pool. In the language of the COMEX, this is the metal that is immediately available for delivery on a futures contract. It is the ultimate liquidity reserve. For 6 consecutive months, this pool has been sitting below its 6-month average, signaling a deep and persistent stress. But the most alarming number isn't the total ounces, it's the coverage ratio. The coverage ratio is a measure of reality. It tells us what percentage of the paper contracts outstanding could actually be backed by physical metal if everyone asked for their silver at once. Currently, that ratio has fallen below the 15% stress threshold and remained there for half a year. In the most recent data, the registered pool stands at a mere 76.88 million ounces. Standing against that physical pile are 575.5 million ounces of outstanding paper claims. Mathematically, that is a 13.4% coverage ratio. Imagine a bank that tells the world it is robust and secure, yet only keeps 13 cents of real cash for every dollar it has promised to pay its depositors. In any other sector of the economy, we would call this a liquidity crisis. We would call it a bank run in slow motion. In the silver market, we call it business as usual, at least until it isn't. This 13.4% represents a razor-thin margin of safety. It is the distance between a functioning market and a force majeure event, where the exchange simply admits it has run out of the very thing it is supposed to trade. This leads us to a question that the mainstream financial media seems remarkably hesitant to ask. Who? Who has a balance sheet so vast that they can absorb billions of dollars of physical silver every single month for a year and a half? Who has the logistical capacity to move that much metal out of Manhattan's vaults without relying on margin or speculative leverage? And perhaps most importantly, why are they doing it while the paper price is being driven lower? In the logic of the traditional investor, you buy an asset because you believe its price will go up. But the entity behind this drain is operating on a different plane of logic. They are not buying for a trade, they are accumulating a strategic resource. They are behaving as if they know that the digital ticker is a distraction, a veil of volatility designed to mask a fundamental shift in the global order of value. Is it possible that the paper price is no longer a discovery mechanism, but a suppression mechanism? If the world's largest and most informed buyers are ignoring the screen and taking the metal, they are signaling that the physical reality of silver is worth far more than the digital promise of it. They are skating to where the puck is going, while the rest of the world is staring at where it used to be. The stakes here extend far beyond the portfolio of a silver bug. This is about the integrity of the pricing systems that govern our global economy. If the COMEX, the heartbeat of precious metals trading, is being hollowed out to the point of a 13% coverage ratio, we are approaching a force majeure path that nobody is watching. We are entering a territory where the price of silver becomes irrelevant because the silver itself is simply gone. As we look deeper into the data, the identity of this silent giant begins to emerge. It is an entity that doesn't care about quarterly earnings or Western media headlines. It is a sovereign force that has realized that in a world of crumbling trust and exploding debt, The only thing that matters is what you can hold, what you can move, and what you can control. The digital lie is reaching its expiration date. The physical truth is being loaded onto trucks. And the mystery of who is driving those trucks is about to reframe everything you think you know about the global economy. To understand why the vaults in Manhattan are emptying, we have to look 6,000 miles to the east. In the world of global commodities, there's a gravitational center that dictates the flow of physical goods: China. For decades, the relationship between China and silver was predictable, almost mechanical. As the world's second largest producer of the metal and its largest consumer, China acted as a stabilizing lung for the market, breathing out excess supply when the world needed it and breathing in what its massive industrial base required. In 2025, that lung was still exhaling. China was a net exporter of silver, shipping approximately 500 tons of the metal to the rest of the world. It was a pillar of the status quo, a reliable source that kept the global paper markets liquid. But in the opening months of 2026, the lung didn't just stop exhaling, it began to gasp. The data for March 2026, confirmed by Chinese customs officials and reported by Bloomberg, sent a shockwave through the analytical community. In that single month, China imported 836 tons of silver. To put that in perspective, the 10-year seasonal average for March is 306 tons. China didn't just beat the average, it nearly tripled it, recording a 78% month-over-month increase from February. This wasn't a ripple, it was a tidal wave. In the space of one calendar year, the world's biggest silver exporter flipped into a country importing the metal at a pace never before seen in recorded history. But the how of this story is just as critical as the how much. In January 2026, Beijing made a quiet but seismic regulatory shift. It reclassified silver as a strategic material. This wasn't just a change in nomenclature, it was a declaration of intent. Overnight, silver moved from being a common industrial commodity to a matter of national security. Exports were strictly restricted to only 44 government-authorized companies. Imagine a world where the primary supplier of a vital resource suddenly builds a wall around its inventory and begins buying up the global surplus at any cost. That is exactly what happened. The premium paradox. Perhaps the most telling piece of evidence that the paper price in London and New York has decoupled from reality is the China import premium. While the screens at the COMEX were showing one price, the domestic price in China was trading at a staggering 12% to 17% premium above the international benchmark. Think about the sheer economic defiance of that number. An irrational, frictionless market, arbitrage, should close that gap instantly. If silver is $30 in New York and $35 in Shanghai, traders should buy in the West and sell in the East until the prices align. But the gap isn't closing, it is widening. This premium is the physical market screaming that the paper price is a fiction. Chinese buyers, the most informed participants in the physical supply chain, are willing to pay nearly a fifth more than the official price just to get their hands on the physical bars. Why would a nation that produces so much silver itself suddenly start cannibalizing the global supply at a premium? The answer lies in the intersection of industrial necessity and geopolitical insurance, the industrial why. We are currently witnessing the most aggressive industrial transition in human history. Silver is the most conductive element on the periodic table, making it the indispensable metal for the green energy revolution. In 2026, China's dominance in the new three, electric vehicles, lithium-ion batteries, and photovoltaic solar cells, has reached a point of no return. A single solar panel requires a significant amount of silver paste to conduct electricity. As China scales its solar capacity to meet its 2030 carbon peak goals, its internal demand for silver is no longer a variable. It is a fixed, massive requirement. By locking down domestic supply and vacuuming up international stocks, Beijing is practicing resource insulation. They are ensuring that their industrial engine doesn't stall even if the Western financial system faces a localized silver shortage. The geopolitical parallel. There is a deeper, more historical layer to this move. China has a long and complex memory when it comes to silver. It was the last major power to abandon the silver standard in the 1930s, a delay that left it vulnerable to the monetary whims of the West. Today, the move back into physical silver feels like a reversal of that historical vulnerability. By reclassifying silver as strategic, China is signaling that it no longer trusts the Western-led paper price to reflect the true value of the resources it needs to survive. It is a form of strategic autonomy. If the US dollar undergoes a period of high volatility, or if the Treasury market faces a collapse in demand, as former Secretary Hank Paulson warned, China wants its wealth stored in a form that cannot be frozen, sanctioned, or inflated away. We have to ask, if the world's largest producer and consumer of silver is frantically buying the metal at a 17% premium while simultaneously banning exports, what do they know that the average retail investor doesn't? They are treating silver not as a speculative play, but as a survival asset. They are building a silver wall to protect their high-tech future from a potential Western financial storm. This isn't just about a trade. It's about the fundamental reorientation of global wealth. The West is selling its physical legacy for paper promises, and the East is quietly, methodically buying it all back. As the first quarter of 2026 tracks as the highest silver import period in Chinese history, the pressure on the COMEX vaults described in Part 1 becomes inevitable. The drain in Manhattan is the direct result of the accumulation in Shanghai. The two markets are locked in a zero-sum game, and right now, the physical metal is moving in only one direction. The mechanics of how this price gap is maintained and why the Western paper price continues to drop while demand explodes is the technical meat of this mystery. It is a system of margin hikes and structural selling that has created the perfect entry point for the well-funded buyers mentioned earlier. But to understand that, we have to look at the gears of the machine itself. To the uninitiated, a market is a simple machine. When demand rises and supply falls, the price goes up. It is the first lesson of economics. But in the world of institutional silver trading, that machine has been modified with a series of complex gears and levers designed to decouple the digital price from physical reality. To understand why the price is falling while the product vanishes, we must look at the mechanics of the market's inner workings. Specifically, the hydraulic press of margin requirements and the rigid mechanical waves of ETF rebalancing. In the financial ecosystem, margin is the lubricant of speculation. It allows a trader to control a massive amount of silver, 5,000 ounces per contract, by only putting down a fraction of the total value as collateral. In a stable market, this leverage is a tool for efficiency. In a tightening market, it becomes a weapon of forced liquidation. Consider the window between December 2025 and January 2026. On December 1st, the cost to hold a single silver futures contract at the COMEX was approximately $15,000. For a mid-sized fund holding 50 contracts, this required a relatively manageable $750,000 in a margin account. But over the next 6 weeks, the exchange enacted a series of aggressive hikes, raising that requirement to roughly $54,000 per contract, a 300% increase. Suddenly, that same 50 contract position required $2.7 million just to keep the trade alive. This is the margin squeeze. It has nothing to do with the fundamental value of silver and everything to do with the liquidity of the holder. If a trader cannot conjure that extra $2 million in 48 hours, the exchange's computers don't ask questions. They automatically close the position. They sell the silver into the open market regardless of the price. When thousands of speculators are hit with these calls simultaneously, it creates a waterfall effect. The forced selling drives the price lower, which triggers more margin calls, which drives the price even lower. It is a synthetic panic, a mechanical flush of the system that creates a massive supply of paper silver on the screen, even as the physical metal remains as scarce as ever. But this margin hike didn't happen in a vacuum. It was timed to coincide with a second, equally powerful mechanical force, the ETF rebalancing window. Every January, the largest silver ETFs, the massive passive funds that hold billions in metal, are required by their own internal prospectus rules to rebalance their portfolios. These funds don't trade based on vibe or geopolitical analysis. They trade based on rigid mathematical formulas. When the calendar turns to the first 2 weeks of January, a structural wave of selling hits the market as these funds unwind the relationships and hedges built over the prior year. This is what analysts call mechanical selling. It is predictable, it is large, and it is entirely indifferent to fundamentals. It is the equivalent of a dam being forced to release water because the date on the calendar says so, regardless of whether there is a drought downstream. The Bank of International Settlements, BIS, the central bank of central banks, noted this phenomenon in a rare public report, stating explicitly that the January correction was not a fundamental move, it was structural. In the clinical language of central bankers, this was an admission that the price drop was a result of the market's plumbing, not its health. Now, imagine you are a sovereign-level buyer. You are a central bank or a state-authorized industrial entity in the East. You have watched the paper markets create this artificial discount through margin hikes and mechanical ETF selling. You see a price on the screen that is 15% lower than it was a month ago, even though you know your own industrial demand is at an all-time high. What do? You say, thank you. You step into the lower prices created by the paper flush, and you stand for delivery. You don't buy paper silver, you buy the physical bars that the margin-squeezed speculators were forced to abandon. You take the metal at the discounted price, you load it into the trucks, and you drive it away. The scale of this physical capture reached its zenith in January 2026. In a single 7-day trading window, 33.45 million ounces of silver were withdrawn from COMEX registered inventory. To put that in perspective, that represents roughly 26% of the entire deliverable pool on the planet's largest exchange, vanishing in a single week. This is the ultimate irony of the modern silver market. The very mechanisms designed to ensure orderly trading, margin requirements, and ETF rules have been transformed into a delivery system for the world's most informed buyers. The paper price is used to shake the metal loose from the hands of the weak and the leveraged, so it can be consolidated into the vaults of the strong and the liquid. We are witnessing a forced migration of value. On the screen, the chart looks like a failure, but in the vaults, the data looks like a heist. By driving the paper price lower through structural mechanics, the system has created a synthetic floor that allows sovereign entities to drain the West's physical reserves at a fraction of their true utility value. This isn't just a technical anomaly, it's a structural transfer of wealth. And as the coverage ratio sits at that precarious 13.4%, we discussed in part 1, the market is approaching a point where the mirage of the paper price can no longer be maintained. When the registered pool can no longer satisfy the trucks waiting outside, the mechanical gears of the COMEX won't just grind, they will shatter. But the implications of this mechanical breakdown extend far beyond the silver pits. This drain is a symptom of a much larger, much more dangerous sickness in the global financial heart, the collapsing trust in the U.S. Treasury market and the arrival of a historical reckoning known as Ferguson's Law. To look at silver in isolation is to stare at a symptom while ignoring the disease. The hollowing out of Western vaults is not an isolated market anomaly. It is the physical manifestation of a much deeper, more tectonic shift in the global financial order. To understand why the force majeure path is becoming inevitable, we have to look past the commodity pits and into the very heart of the global reserve currency. We have to talk about the U.S. Treasury market and the arrival of a historical reckoning known as Ferguson's Law. For nearly a century, the U.S. Treasury bond has been the risk-free asset upon which the entire world was built. It was the bedrock of trust. But in fiscal year 2024, a silent milestone was passed, one that historians may eventually point to as the moment the fiscal event horizon was crossed. For the first time in American history, the United States government spent more on interest payments for its national debt than it did on its entire defense budget. The numbers are staggering. $1.13 trillion in interest payments against $954 billion for national defense. When a superpower begins spending more to service its past than to protect its future, it triggers what historian Niall Ferguson calls Ferguson's Law. The principle is deceptively simple. Any great power that spends more on debt service than on defense risks ceasing to be a great power. Why? Because the debt burden becomes a parasitic force, starving every other national priority, from education and infrastructure to technological innovation. It is the sound of a country running to stand still. The Congressional Budget Office, a nonpartisan entity, has projected an even grimmer reality. By 2031, 100% of U.S. tax revenue will be required just to fund mandatory entitlement spending and interest on the debt. This leaves exactly $0 for everything else. No money for the military, no money for the FBI, no money for the interstate highway system. Every single function of the federal government, beyond Social Security, Medicare, and debt interest, would have to be funded entirely through new, additional borrowing. This is the macro context that explains the well-funded buyers standing for silver delivery. They aren't just buying metal, they are exiting a debt trap. There are only 3 historically proven exits from a debt burden of this magnitude. The first is to produce your way out through a manufacturing revolution. But the U.S. manufacturing base has been largely offshored over the last 30 years. The second is a formal default, an admission that the promises cannot be kept. However, a formal default on Treasury obligations would be the financial equivalent of a nuclear detonation, instantly vaporizing the global banking system and the life savings of billions. That leaves the third path, the path of least resistance. You inflate your way out by debasing the currency. You pay back the trillions you owe with dollars that are worth a fraction of what they were when you borrowed them. It is a slow-motion default, hidden behind the rising prices of groceries, energy, and, most tellingly, precious metals. This isn't a gold bug conspiracy theory. It is a contingency plan being discussed at the highest levels of the American establishment. Former Treasury Secretary Hank Paulson, a man who stared into the abyss during the 2008 financial crisis, recently broke his silence with a chilling warning. He publicly called for U.S. authorities to draft an emergency contingency plan for a potential collapse in demand for U.S. Treasuries. Think about the weight of that statement. The man who once held the keys to the U.S. Treasury is telling the world that the market for U.S. debt, the most liquid market in human history, might simply stop functioning. He warned that the plan needs to be ready before the crisis hits, because when it does, it will be vicious. If the world's institutional capital senses that the Treasury market is facing a demand collapse, where does it go? In a world of digital freezes, swift sanctions, and currency debasement, capital seeks out extraterritorial assets. It seeks out assets that carry no counterparty risk, assets that do not require the permission of a government to exist or the solvency of a bank to trade. This is why we are seeing a global repatriation wave. Countries like Germany, France, the Netherlands, Poland, and the Czech Republic have spent the last few years quietly pulling their gold reserves out of the Bank of England and the Federal Reserve. They are taking their metal home. The convenience of a centralized global exchange is being traded for the security of a domestic vault. Trust in the custodian has eroded, and in the world of high-stakes geopolitics, if you don't hold it, you don't own it. Silver is the high beta shadow of this movement. While gold is the asset of central banks, silver is the asset of the industrial and strategic future. The ripple effect of the Treasury crisis is a massive reallocation of capital into the only two assets that have survived every empire in history. The winners in this shift are the entities that recognized the Ferguson's Law threshold early, the sovereign buyers in the East, the institutional managers abandoning the 60-40 model, and the retail holders who ignored the paper smashes to secure physical ounces. The losers are those left holding the paper claims when the 13.4% coverage ratio finally hits zero. We are moving toward a force majeure world, not because of a secret cabal, but because of the cold, hard mathematics of debt and interest. The drain at the COMEX is the early warning siren. It is the signal that the world's most informed capital is already skating to where the puck is going. They have seen the fiscal event horizon, and they are choosing the permanence of metal over the volatility of a promise. As we enter the final part of this analysis, we must look at the final verdict. If the paper price is a lie, and the physical vaults are emptying into a strategic silver wall in the East, what does the future actually look like? What happens when the world's largest asset managers finally hit the buy button on an asset that is no longer there? We are approaching the terminal velocity of a 50-year financial experiment. For half a century, the global investment thesis was built on a simple, elegant foundation, the 60-40 portfolio. It was the North Star for pension funds, sovereign wealth managers, and retail retirees alike. 60% equities for growth, 40% bonds for safety. It was a model predicated on the idea that the U.S. Treasury market would always provide a risk-free return, and that currency debasement was a ghost story from a distant, less sophisticated past. But as the data from 2026 begins to settle, that foundation isn't just cracking. It is being formally abandoned by the very institutions that built it. The chief investment officer at Morgan Stanley has declared the 60-40 model dead. In its place, a new, more defensive architecture is emerging, the 60-20-20. The final 20% isn't going into safe paper debt or speculative tech. It is being reallocated into precious metals. This is the sound of Wall Street's smart money, recognizing the Ferguson's Law threshold we discussed in Part 4. When the bond king himself, Jeffrey Gundlach, a man who built a multi-billion-dollar empire on the stability of the bond market, states that a 25% allocation to gold and silver is not overweight. The Overton window of finance hasn't just shifted, it has been shattered. Michael Hartnett, the chief strategist at Bank of America, has echoed this sentiment, signaling that the era of return on capital is being replaced by an era of return of capital. The arithmetic of desperation is driving this shift. As BlackRock begins to restructure its massive holdings, selling off bonds to move heavily into commodities, they are effectively admitting that in a world of $1.13 trillion interest payments, safe paper has become a liability. They are looking for assets that carry no counterparty risk, assets that cannot be defaulted upon because they are nobody else's promise. This brings us to the final verdict on silver. If gold is the insurance policy for central banks, silver is the coiled spring of the global industrial economy. Right now, the gold-silver ratio, the measure of how many ounces of silver it takes to buy 1 ounce of gold, is at historically elevated levels. In every major market cycle in modern history, these levels have acted like a stretched rubber band. When the snapback occurs, silver doesn't just track gold, it violently outperforms it. The current delivery data from the COMEX and the unprecedented import premiums from China both suggest that the coming compression of this ratio will be more violent than gradual. The institutional forecasters are no longer whispering. Bank of America's chief analyst has publicly set a silver target range of $130 to $139 for this cycle. These are not the fringe predictions of internet enthusiasts. These are the calculated projections of the world's largest bullion banks. And while those numbers may seem high relative to the paper price today, they are actually conservative when measured against the hollowing out of the physical vaults. We must return to the Gretzky principle. I skate to where the puck is going, not where it has been. The paper price on your screen is where the puck has been. It is a trailing indicator, a digital ghost of margin hikes and mechanical ETF rebalancing designed to facilitate one final massive transfer of physical wealth. The puck is currently moving toward the trucks leaving Manhattan. It is moving toward the 836-ton monthly imports in Shanghai. It is moving toward the 13.4% coverage ratio that signals the end of the COMEX's ability to satisfy the physical demand of a sovereign world. The force majeure path isn't a single dramatic day where the lights go out. It is a process of realization. It is the moment the market realizes that the strategic reclassification of silver by the world's second largest economy wasn't a policy tweak, but a survival tactic. It is the moment the Western investor realizes that while they were watching a chart move down by 50 cents, a sovereign entity was removing 26% of the world's deliverable inventory in 7 days. The final verdict is that we are moving into a trust deficit economy. In an era of collapsing treasury demand and $35 trillion in national debt, trust is the rarest commodity on earth. You can trust a paper contract until the warehouse is empty. You can trust a digital currency until the network is sanctioned. But you do not need to trust a bar of silver. Its value is intrinsic, its utility is industrial, and its supply is finite. Every person holding physical silver, PSLV, or allocated metal is currently positioned exactly where the most well-informed, well-funded money in the world has been accumulating for 18 straight months. The paper price is the distraction, the vault drain is the signal. The window for this accumulation is closing. As the China premium widens and the COMEX coverage ratio continues its descent toward the single digits, the force majeure scenario moves from a theoretical risk to a mathematical certainty. When the paper market can no longer deliver the physical metal, the price will no longer be determined by a margin hike in New York. It will be determined by the desperate needs of the industrial world and the strategic reserves of sovereign nations. At that point, the question won't be, what is the price of silver? The question will be, does anyone have any silver to sell? The puck is moving. The trucks are driving away. The digital lie is reaching its expiration date. And for those who have been watching the signal instead of the noise, the rewards of reality are about to become very, very clear. The force majeure path is no longer a conspiracy. It is the only road left.